Hey there, and welcome to my channel, Money Mindset. If you're new to investing and feeling overwhelmed by all the different options out there, you're not alone. I was in the same boat when I first started, but don't worry, I've got you covered. Today, we're going to dive into the world of investments and break things down in simple, easy to understand terms. We'll be focusing on three popular types of investments: mutual funds, index funds, and ETFs, which stands for exchange-traded funds. If these terms sound like a foreign language to you right now, that's perfectly fine. By the end of this video, you'll know exactly what each of these investment options is, how they work, and how they can fit into your financial goals. If you find this video helpful, make sure to hit the subscribe button and click the bell icon so you never miss out on our latest content. And if there's a specific topic you'd like me to cover next, let me know in the comments below. All right, let's jump in and start making sense of these investment options. First, let's talk about what these investment options actually are. At a high level, mutual funds, index funds, and ETFs are all types of investment funds. An investment fund is like a basket that holds many different investments, such as stocks, bonds, or other assets. When you invest in a fund, you're buying a small piece of that basket, which gives you access to a wide range of investments all at once. Think of it like a fruit basket. Instead of buying apples or oranges, you get a bit of everything. Apples, oranges, bananas, which spreading out your risk. Before we dive deep into these investment options, it's important to understand a key term called the expense ratio, which is a crucial factor when choosing between these options. An expense ratio is the annual fee that a mutual fund, index fund, or ETF charges its investors to cover the costs of managing and operating the fund. This fee includes expenses for portfolio management, administrative services, distribution, and other operational costs. Expense ratios are typically expressed as a percentage of the fund's average net assets rather than a flat dollar amount. For example, if a fund has an expense ratio of 0.56%, it means you'll pay £56 for every £10,000 you have invested in that fund each year. In contrast, a lower expense ratio of 0.07% would mean you'd pay only £7 for every £10,000 invested. While these percentages may seem small, they can significantly impact your returns over time, especially in the long term. That's why understanding and comparing expense ratios is crucial when selecting an investment fund. Now let's break down what mutual funds, index funds, and ETFs are and how each of them works. First up, mutual funds. A mutual fund is a type of investment where money from many investors is pooled together to invest in a variety of assets like stocks, bonds, or other securities. This pool of money is managed by a professional fund manager who makes decisions about how to invest that money, aiming to achieve the best returns. But here's the thing: mutual funds can be actively managed or passively managed. In an actively managed mutual fund, the fund manager tries to beat the market by picking and choosing stocks or bonds they believe will perform well. This requires a lot of research, analysis, and sometimes a bit of luck. Because of this active management, mutual funds usually come with higher fees called expense ratios. So you're paying for the manager's expertise. The typical expense ratio for actively managed mutual funds ranges from 0.5% to 2.5% of the assets under management, AUM, per year. However, some funds may charge even more. But remember, even the best fund managers can't guarantee profits. On the other hand, there are passively managed mutual funds, which aim to mirror a specific market index, like the S&P 500. We'll talk more about that next when we get into index funds. Now let's talk about index funds. An index fund is a type of mutual fund designed to replicate the performance of a specific market index, such as the S&P 500, which stands for Standard & Poor's 500. Let's try to understand what is an index. A market index is essentially a group of stocks that represents a portion of the overall market. For example, the S&P 500 index includes the 500 largest publicly traded companies in the US, such as Apple, Microsoft, Amazon, Google, Tesla. Instead of trying to beat the market as a mutual fund by the fund manager, index funds track the market. This is what we call passive investing. Because there isn't a team of managers actively picking and choosing stocks, the fees or expense ratios tend to be much lower than those of actively managed mutual funds. The typical expense ratio for index funds is very low, usually ranging from 0.05% to 0.2% per year. Some of the most popular index funds, like from Vanguard, can have expense ratios as low as 0.04%. For many beginners, index funds are a popular choice because they provide broad market exposure at a low cost. You get a little piece of the entire market, which reduces your risk. But remember, because you're tracking the market, your returns will generally match the market, neither higher nor lower. If the market goes up, you go up with it. If it goes down, well, you get the idea. Lastly, let's explore ETFs, or exchange-traded funds. Think of an ETF like a cousin to both mutual funds and index funds. ETFs, like index funds, usually aim to track a specific index or sector, but they have a few key differences. ETFs are traded on stock exchanges, just like individual stocks. This means you can buy and sell them throughout the trading day at market price, unlike mutual funds, which are only traded at the end of the trading day. ETFs generally have lower fees, similar to index funds, and are known for their tax efficiency. Since they're traded like stocks, you can use strategies like limit orders or stop-loss orders, which is a level of control you don't get with mutual funds. But just like with index funds, if the index goes down, so does your ETF. All right, let's summarize and compare these three options. Number 1, mutual funds, actively managed, higher fees, managed by professionals. Good if you want a fund manager making decisions for you. Number 2, index funds, passively managed, lower fees, track a market index. Ideal for beginners who want low-cost exposure to the market. Number 3, ETFs, traded like stocks, can be bought and sold throughout the day, lower fees, tax efficient. Great for those who want flexibility and control. Choosing the right one depends on your financial goals, risk tolerance, and how involved you want to be in managing your investments. For those just starting out, index funds and ETFs are often recommended for their simplicity and low cost. If you want a more hands-off approach and don't mind paying a bit more, a mutual fund might be for you. So there you have it. Mutual funds, index funds, and ETFs all have their unique pros and cons. It's all about finding what works best for you. Remember, the most important thing is to start investing and let the magic of compounding work for you over time. Remember, building wealth isn't just about how much you make, it's about how you manage, grow, and protect what you have. Let's build a smarter, more prosperous future together. Thanks for watching, and welcome to the Money Mindset community. I'll see you in the next video.